everyone. Yeah, I guess we will start our webinar. And here we have Chris and me, and we will start with some introduction. Both of us, we are economists, and we studied trade and we studied international finance, and now we are practicing transfer pricing for over 15 years. We are in Canada, and we deal a lot with Canada-US transactions. And then naturally we have tangible goods transactions, and then we get involved into customs valuations issues, and we're involved in customs defense and also planning from sales and customs valuation perspective. So we have some experience, and then now, and like when there is a lot of discussion about tariffs, naturally we're involved in those reviews, and we can see that there is lots of suggestions about changes to supply chain, movement of production of intangibles, and all of that is interesting. Or like there's also interesting ideas, but also another element that should be asked is what is the cost of doing that, of is restructuring warranted or not, right? Because moving the production facilities like fixed assets and then hiring labor, it's expensive, and then it's something that can be achieved in the long run, but probably in the short run, so the focus should be a little bit different, and that's something we would want to focus on today. And then also we would probably, as economists or transfer pricing economists, we would need to consider their alternatives, which are available in terms of the planning and planning for that. The focus we see with our clients is information gathering and modeling, and at this stage, and that's probably something that needs to be emphasized, and that's what we involved a lot at this stage. Okay, so yeah, now this on the slide on the screen, we just wanted to demonstrate that there can be different channels that affect your business, and sometimes you can be affected directly, or sometimes you can be affected indirectly. And it affects your business, but also when we perform analysis from economic or transfer pricing perspective, it affects the way we are doing our analysis. And for example, you should be thinking about macroeconomic environment, you should be thinking about the industry and market you're in, and then you will be thinking about customs value because of the tariffs, and also the effect on financial statements and transfer pricing analysis in the end of the day. And as an economist, I probably would say that there are no good news, because if you're talking about tariffs, who usually benefits from that? That's usually an entity that would be like domestic, isolated, without international trade. That entity would benefit from tariffs, theoretically. But we are in transfer pricing world, and we are dealing with related party transactions and multinational companies, and they will be affected one way or another. There can be a lot of bad news for the multinational corporations. From a perspective of macroeconomic environment, you probably can expect inflation because of tariffs, and probably you can expect slower growth and employment. If you, looking at the industry or the market, you can probably expect the price level in the market to go up, and depending on if you're exporter or importer, and depending the effect on your market, you can be affected in positive or negative way. For some companies that let's say importing necessities, they can be affected less because the demand is not as elastic. But if you're talking about some luxury goods, you are probably affected more. That will be taken into consideration. And for some it can be a positive effect, but the economic environment may be not that positive, so the total effect is not very clear as well. So it creates a lot of uncertainty because of those moving parts. And then we will talk a little bit more about the customs value, and then we will focus about like a little bit more on effects on transfer pricing and financials, and also comparable companies, because that will be key for transfer pricing analysis in the next year or two, until we will see what is the effect on the markets and on the comparable companies, how the ranges will change. That will take some time. Chris, anything else, or shall we just move to the next one?
Go ahead. I think you have an interesting slide on the next one.
Yeah, okay. So yes, here we just wanted to touch base on some customs value terminology and certain concepts that come to mind to us as transfer pricing specialists, not customs specialists. So we aware of certain things, but we cannot say that we are experts. And then we just wanted to share that for you to keep it in mind, that there are certain options that can be helpful, right, for you, for your goals. And so from your transactions may be subject to customs duties, but there can be exemptions. And then you should really think what may be the exemptions applicable, what is the timing of new tariffs, and also do you know if you have certainty about the tariff rate that will be applied. It can be 25% and it can be 10%, and then 10% can be a different story than 25%. So all of that you need to prepare yourself and be prepared to model for different situations. And then some of the terminology that you probably will need to be aware of is this first sale declaration, and then about additions, so-called additions in customs valuation, and then condition of sale and reconciliation program, and bonded warehouses. And what's interesting is that very often customs valuation, they can be relying on transfer pricing documentation. So if you have a transfer pricing documentation prepared properly, it will help to defend your position as well. And in that case, you will need to prove that the transaction value is consistent with the arm's length principle applied. Something that can help to reduce value for customs purposes, if you have first sale declaration, for example, a product is purchased from a certain jurisdiction and then sold to a related party, and then the related party sells to the US. In that case, if we get rid of the intermediary, it will simplify the process of defending the value of the product, and it can be lower potentially for application of tariffs. So-called additions, those are things like royalties, commissions, transfer pricing adjustments, and then they can be added to the value of goods, or sometimes you can avoid adding those. And then it's a complicated discussion as well, and then we'll touch base, or we can touch on that in later slides. Then condition of sales, that's one of those things that are important for royalties application. Royalties can be added to the goods, value of goods, or may not be added. And then it should be condition of sale. If it's not a condition of sale, meaning that it's not, it can be charged separately, or it doesn't consider to be part of the value, then the value of the goods can be can be lower. But be aware that it's a minefield and it's highly contested area, lots of court cases around that. So it's better to do a very rigorous analysis and consider what is feasible and what is not. Again, we will have a little bit of discussion of that in later slides, but keep this in mind. And reconciliation program, that's important, I understand, is because you can, if you get on that program at the early stage and then you decide to make adjustments down the road, then you can do it over a more extensive period of time. For example, instead of 3 months, it can be 18 months or something like that. Yeah, I cannot profess that I know all the details of those programs, but that's something you need to keep in mind and need to consider potentially. And bonded warehouses, yeah, that's usually helping with managing the inventory. And sometimes we see that there are some distribution centers or like inventory management when it's sold to related party and then returned just for inventory management purposes. With tariffs, all of that will be more complicated. So it's better to consider this option as well when the inventory is stored in those warehouses and then sold only when you know where the product will actually end up going. Then I'll move to the next one.
Good. I'll take over
Chris,
this
yeah,
one. Yeah.
yes,
Yeah. Thanks for that, Pablo. I'd just like to touch on a few what I call mitigation measures. Like this is more of a discussion. What we're showing here will be something, things that we've heard, things that we've explored. Pablo and I are discussing this internally. What on a high level, what measures are available out there, realistic, in terms of mitigating the impact of tariff. But just before we start, the, uh, this doesn't what we say here does not reflect any client facts. This is only for discussion. We'll tell you the pros and cons. We're here to summarize it for you, distill it down, so something you can understand. But ultimately, whatever any of these mitigation measures, what you will, if you end up selecting one, that's that you have to base that on your own facts and circumstances. We're not endorsing anything here. We're just saying this is what we're hearing or trying to distill it for you. Well, the very first thing, if you have the tariff, the first thing, if you are, let's say, a monopoly or something who a price maker, if you will, in the market, you may actually decide to just pass on the tariff, all of it, to your end customer. Uh, but of course, that is if you are facing little competition. But probably this is unlikely to be sustainable in the long run, as probably your customers will seek alternative suppliers. The other one we're thinking is reduce the intercompany price to the purchasing entity, the importing entity. That may work if, let's say, you have an entity where, let's say, U.S. entity in this case is a limited risk distributor. You're the principal entity, and then being the principal entity, the way it works is you can assume losses as a result of the tariff and not pass it on to your limited risk distributor. You call them that way because of the limited risk. That's another potential thing to do. But again, it's not something sustainable in the long run because of the impact to overall group profit. If you have to think about that, shortly we'll show you a bit of a very high level P&L to show you to demonstrate this to you. The other one, I think Pablo touched on this, the unbundling of transactions. What it means is it's possible that many companies are, importing goods, and the price of that good is just not the price of the good. It has in it implicitly the IP that's embedded in that good, probably services that are also attached to that good. So sometimes there will be discussions where somebody will say, well, if we've been doing that, why don't we just unbundle it? And we'll show you a bit of an example later on, but why don't we just reduce it to the very price of the good and sell that so that you can reduce the customs value? Well, that's possible, of course, but also understand if you do that, you have to charge separately now for the royalty and also for the unbundled services. Now, when you do that, it becomes another transaction that is auditable, something that you have to declare in your Canadian T106 or your US 547172. And that would require separate studies, like, for example, valuation of the royalty or even the benefit of the services that are being now introduced as a new transaction. Let me get now. Pablo has written this. Pablo, you want me to go on and explain this a bit, or
Yeah, sure. So yeah,
yeah,
at some point, a client came to Chris and then asking a question, and then we get together to discuss and start like modeling. And I think it will be important for everyone to start this exercise. And we just wanted to give an example, just to give a taste of what it is. And in this case, we have a limited risk distributor in US, and then when the tariff of 25% is imposed, then we can see the effect on the profit and then operating margin, and then we can see that this limited risk distributor is now in losses, and then at the same time Canada is paying a lot of income taxes, and overall the net profit is negative. And usually in those situations, clients come to us and say, how come we have those losses and paying taxes at the same time? So as a next step, maybe I will move on. So here we have this exhibit 1 and exhibit 2. In this slide, we just repeat exhibit 2 when they are in losses situation, and then the question becomes, okay, what do we do? So what if we adjust the price, and then let's adjust the price so that we get to approximately the same operating margin for the limited risk distributor, because that's what we do a lot in transfer pricing. And that adjustment is like $40 here, and we see that now the limited risk distributor is okay, and then we can see that on overall basis it looks better, but now the problem is Canada, naturally. And the problem is that it has very low return in Canada, and the stakeholders will ask a question: will it even provide return on fixed assets or intangibles we're using? This is too low. I'm not even mentioning taxation authorities that will eventually come and ask those questions as well. So then after that, it requires the next step. Okay, so how do we do to make both taxation authorities happy from US and Canada perspective? Will we need to stick to that approach when we guarantee the return for the US, or it can be lower, or it can be something transitionary, and we need to bring it down significantly to keep Canada more profitable and keep everybody happy on Canada's end.
that's the dilemma, right, Pablo? So, by the way, before anything, what Pablo was showing here is the decrease in price is the decrease in the intercompany price from Canada to US in exporting country to importing. And what Pablo is saying here is, if the US entity or any entity for that matter who's a limited risk distributor, you are bound by the agreement or the very TP model to keep that limited distributor in a profit position, maybe a routine profit, maybe a minimal profit, but still in a profit position. So Pablo is saying here, between exhibit 2 and 3, that minus eight, sorry, that negative operating profit in the US cannot stand if you follow your TP policy. So I think what he's showing here is, so the losses now will be absorbed by the Canadian entity, which in this case, in our example, is the entrepreneurial taking entity, or we call it sometimes principal entity. You may see these terms quite used interchangeably, but you see the impact, right? We bring back the US LRD into this routine profit, but the impact on the Canadian profit is really massive, right, Pablo? That's what we're trying to show here.
Yeah. Yeah, and then after that we had the next steps. Okay, so what if we play with margins? And then for all of that, we did some additional steps to help the client to set the policy that would be optimal. And from what I saw from that exercise, it's some kind of non-linear exercise. It's not just one-to-one because of differences in tax rates and other factors that play here.
Okay. We'll go on to the next slide. But this is interesting. Remember, we met this. We're just showing an example of that unbundling transaction I mentioned earlier, and Pablo already alluded to in the first few slides. If in this case we're just showing you the product itself, and that is country B. What's this? So what we're saying is, well, in this scenario, you just see these two containers here. The product itself, the cost of it may just really be that black portion at the bottom, but in actuality, mostly products when they're sold, embedded in them is the IP. When I say IP, the trademark, the brand name that goes with it, the manufacturing know-how that went into its production, all of that. And even sometimes, and they do this, valuable services attached to buying that product, right? So what I'm saying when we say unbundle, of course, it will be your interest to remove those IP and valuable services and just pass through and just sell the product itself. That will reduce the customs value. But again, as we mentioned earlier, you will have a new service transaction. If you unbundle it now and charge, you just sell the product and charge services and royalties separately. Now you have a new transaction. And for the service transaction, now you have to demonstrate what's the benefit of the entity paying for the service. That's something being required in transfer pricing. Second thing is the royalty payment. What's the value of this intangible, and what would be the appropriate royalty rate? And second thing is, I have to consider the withholding tax on the royalties, depending on the jurisdiction. And also, I think probably the other question we have is in royalty, right? They would ask you if you did not charge for this separately, why now, right? That's another.
Yeah, that's a big
sort of
question, right?
another-
why now? Yeah, why it's
Why
happening?
now? Yeah, it's been there before. Uh, Obviously, we know that the issue is mitigate the tariff impact, but you still have to answer that TP question that any auditor would ask from the start. Why now? Why charge this? Why unbundle and why charge separate royalty and service transactions?
And sometimes it's as simple as transportation costs and insurance, right? Sometimes we see that it's included in the value, right? Sometimes we see that it's unbundled, and then that's something that can be easily unbundled.
Correct.
The analysis will be needed there.
So that's just again just giving you a flavor. I think on the an additional discussion point here again, we're talking about alternatives here. Another option would be if you already are charging intercompany service fees, would you want to increase that? Well, maybe to mitigate the impact, right? Of if you want to reduce the value of the good you're selling, but you're also charging services, would you want to increase that service fee? Well, it's up to you, of course, but the question again would be, what is the conferred benefit of that additional fee? What's going on? Why is it uh, employees from the service providing entity now providing they're taking more time in servicing the recipient entity? This would also an increase in fees would likely invite a TP audit. The other one is again, reduce intercompany prices. We're just sort of repeating what we're saying here earlier. When you put the royalty in there and substitute it with royalty payments, it will reduce the customs value, obviously, but the new royalty transaction will be subject to an audit. And again, we have to consider withholding tax payments on withholding tax on the royalty. This other one, we have the third one, revisit inventory management. I think Paulo were discussing this the other day. Inventory management strategies, you have to think about them now. What is that? Is there something more in this strategy that you can do where you can mitigate so the goods won't touch a tariff imposing country, right? And then tariff may increase the cost of inventory management. But I think we also discussed this probably another potential thing you can do is use bonded warehouse. Ship them to the bonded warehouse and they won't get tariff tax until they are, that they're eventually come out of the warehouse and sold to the end customer. Another interesting one, although this is a long shot, and before anything, if you notice this, we're not even discussing here whether it's long term or short term. Your mitigation will depend on how you see tariffs, whether do you think they're long term or just short term. If they're long term, for example, this last one, this may make sense. You're moving functions from one country to another. So let's say you're producing something in Canada and all the manufacturing assemblies there, and that all goes into the product price. Would you now try to say, let me take out one function in Canada and bring it to the US? So that's another question. That's another potential issue, that potential mitigation measure. You reduce the product price there. But then you're going to increase the functional profile of the importing entity. The LRD ceased to exist as an LRD, but probably LRD with distribution functions. So now you have to think what's the compensation for that. An LRD with assembly functions. Now you have to consider whether that what kind of compensation you have for that additional function. Again, the other thing we're discussing this, if you do that, but what if all of a sudden the tariff regime is just temporary? We don't know, of course, but what if they prove to be temporary? Oh, thank you, Pablo. This is the one we're saying should have gone to this. So this is the one we're trying to
Just
show.
an
So let's say,
illustration. Yeah, what
yeah,
you're saying. Yeah, yeah.
the country A is manufacturing, they have the IP, they have assembly. Country B is just using just distribution. So what if let's say you want to move that assembly pie into the other country? So that means lower product cost from the original manufacturing entity, but more functions into the limited risk or the distribution entity, right? So there will be a question on long-term execution. Unfortunately, there are probably reduction, layoffs in the manufacturing entity because the assembly you're going to move it somewhere. Financing will also be a question because probably you have to acquire a new assembly warehouse. This is also interesting and was brought something we considered. Is it that easy to hire a new management to oversee that assembly operation? What's the labor? Are you wherever you're located? How is the labor? Is it easy to get them there, obtain them, and train them?
And we've seen situations when our clients were commenting that we cannot find labor in the local market because they
That's
are
true.
not qualified or not trained, or it's not typical in this region to have this kind of operation, and then people need to have certain skills and experience.
Correct. Yeah, that's another one, right? It's that hidden cost, if you will, of pursuing this, and then so again, thinking a bit again about the mitigation measures you can think of. Well, I think probably you should have been doing this even before the test, like reviewing your supply chain and seek suppliers from non-tariff impacted regions. What we're saying is just go to your supply chain. There may be five, six, or just maybe three stages, and then just select which one you can mitigate by, let's say, you outsource this somewhere else, right? But then again, we have to understand you set up this value chain, this supply chain, sorry, because of a commercial rationale, right? So now you're abandoning that. It now becomes more heavy focus on just avoiding the tariffs. So now that's going to be an issue again. The other question we have is what going to do this if you view the tariffs as something long term or something more permanent, right? We're talking about 2 3 maybe 5 years that the tariff regime will continue and persist. The other one though, and we'll throw this in, probably you can comment on this one, where there's, if you want, there's always potentially a way to potentially revisit your agreements with your third party customers, right? Restructure the terms. I don't know if you can say that the tariff is a government action that is a force majeure kind of situation. So we can now, reconsider, see how we can, in effect, share the burden of the tariffs. Again, that's something you can do. Depends on the strength of your relationship with the customer you're trying to, renegotiate the terms with. But again, it's unlikely. This is unlikely to be sustainable in the long run just like because they can, your customers can really consider going to alternative suppliers. And let's see what else.
Yeah, and I
Yeah,
think,
go
Chris,
ahead,
we,
Pablo.
we are running out of time, and then I hope everybody can download the slides, and then yeah, like consider those like various options we are mentioning here, and then yeah, maybe you can provide us some feedback on, and we will be happy to discuss. The only thing I think we need to highlight in the remaining slides is how it affects analysis from transfer pricing perspective. Right,
Mm-hmm,
because ideally in transfer pricing, we want it to be in some kind of a stable market, some kind of steady state condition. But because of tariffs and changes, and it's all very dynamic, and we like different companies will be affected differently, and they will not be disclosing
mm-hmm,
how they are affected. So it will be very difficult to make any adjustment. It will take some time to get to a new state, let's say, and they will start reporting their financials with 1 year lag. So from transfer pricing analysis perspective, it adds a little bit
mm-hmm.
more complication.
Yeah, I think you're talking about this, Pablo, right? That's a big
Yeah.
question everybody's asking. If we have just 1 more minute on here, we'll just say at the end of the day, people are asking how the benchmarking is impacted. We'll be honest with you, we won't get the full 2025 financials of most North American companies until second part of 2026. EMEA, APAC until probably mid to the third quarter of 2026. So consider the timeline. So in short, we don't know the impact. We can see companies releasing their 10Q quarterly reports. They may or may not discuss preliminary tariff impact. We don't know. So it's challenging to plan. Also, I think you might be hearing this concept of comparability adjustments. What they're trying to say is once we get the TP practitioners like me and Pablo, we get 2025 data, we may try to find a way and quantify the impact of tariffs either on the comparable companies or on the tested party, meaning that would be you and whoever your distributor or tested party is. But we don't know that. We don't know what those comparability adjustments are. We don't even know if companies will quantify the impact of tariffs when they disclose in their financial statements. So that's something you have to consider. Unfortunately, Pablo, I would say it's we don't have the answer now. Probably
Mhm.
when we have it once we see full 2025 data. But it's just hard to answer questions on how this will impact our benchmarking.
Yeah. Yeah. I see there are a few questions. I will try to generalize and answer them. And the questions are like if the tariffs are lower, and we have a risk of getting more taxes due to profitability, and also another question is if there is anticipation of more scrutiny for American companies. And yes, one thing we didn't mention probably is that what's interesting about customs value and transfer pricing is that they work in opposite directions, right? So, and then you can probably see that in the numeric example as well, that the authorities in the US would be collecting more uh, based on the value of those goods.
Mhm,
And then at the same time, the value goes up, and then the profitability of the entity goes down. So they're losing some revenue or tax tax dollars collected. They work in the opposite directions. And then, yeah, if the US is doing that, so they should be happy potentially, right? As at the government level, that they collect more revenue, they will be gaining more than losing in tariffs. And then when we were doing our modeling, we can also see that's how it work high level. And then because of that, yeah, there can be more scrutiny, but possibly it will be less likely to be scrutinized because yeah, hopefully the authorities are also aware of the effects of tariffs, and then it probably will be uh, discouraging them from doing more audits. Chris, what do you think? Would you agree with
Yeah,
that?
I agree with that. Yeah, I agree with that. Any additional questions they were asked? Pablo?
Okay. So yeah, then there are a couple more questions about terms of transfer pricing policies and tariffs, and also about the restructuring and what do we have to keep in mind about the restructuring and tariffs, and which steps to follow for entities. The move. Okay, so I guess it's moving functions. Yeah, so moving functions due to tariffs. Yeah.
What to consider, isn't it? Very interesting. I think the very first one is you have to consider whether you think this is a real long-term or short-term tariff regime. When we say regime, it's just the that situation where you have high tariffs now. You have to consider that. And second thing is, what is your appetite for taking that risk, moving the functions around, even moving? I think, Paolo, right? They were saying moving IP to another jurisdiction. Understand though that when we write your transfer pricing reports, there's an assumption of characterization of who's limited risk, who's the entrepreneur risk-taking entity. When you try to move that, obviously the benchmarking will no longer hold, the characterization will no longer hold. There will be additional costs that will be incurred. When we look at your financials, we have to understand what those additional costs are so we can take them off of the income statement and sort of quote normalize your operating profits so that we can test them appropriately. Many things. Again, well, I'm thinking intercompany agreements would have to be revisited if you're moving certain functions, things like that, right?
Yeah, and also because I think we are in the situation with more uncertainty, right? And then usually the recommendation from like OECD, when there is more uncertainty, then you probably need to build in some mechanism to deal with uncertainty, to make adjustments more flexible. So that's something that may need to be built into those agreements in terms of the adjustments. And in terms of the issues with restructuring, and we mentioned that earlier, no matter what you do, the taxation authorities will question that, right? If you move it, they will ask about the past. If you don't move it, they will ask you about the future. So it's very tricky to address those. You just need to make sure that the transactions align with the operations and economic substance, and then so that it's all reasonable from business perspective, and considering short term and long term, because something that you can continue doing in the short term may not make sense in the long term, and then you will have a business reason to restructure, and all of that needs to be documented.
Yeah, documented now, and you have to document now. And the reason we say that is because you'll never know. Audits there, they have a time lag, right? Normally 2 years. So 2025 now, they may be asking for your 2023 and 2022 documentation. So in the future, when you get asked a question, maybe the person who was deep into the restructuring process may already left the company or moved to another role. So you want to make sure you preserve and document, memorialize whatever the decisions were made, commercial rationale, the steps taken. You want to demonstrate that there's there's the business reasoning behind the restructuring, and those bits and pieces, the stages of restructuring, you have to document them. Any other questions they have, Paolo?
Yeah, the only one is if new documentation would be needed if we new countries are considered or involved, and the answer is yes. Yeah, because it's like a new jurisdiction, new operation, new transactions. Then the new documentation will need to be prepared from that country perspective, and then from the group or other parties involved perspective as well.
Right, and when you do restructure, I'm sorry, we're belaboring on this. You have to also say that in your master file, and in fact, you have to say it in your documentation, right? Your every local file must be marrying up to the restructuring narrative. Okay, anything else?
Yeah, I think these are all the questions, and then we are going over by
Sorry.
Few minutes, and I hope it's helpful, and I'm very happy to hear those questions and the engagement. Yeah, thank you so much for joining the call. And yeah, if you have any other questions, we'll be happy to respond and discuss. Please feel free.
Thank you.